Something happened on March 30th that most people in crypto completely missed. Not because it was hidden, not because it required some secret clearance to access. It was published in broad daylight by one of the most powerful technology companies on the planet, and the financial media didn't explain it, not properly, not with the seriousness it deserved. While the charts were flashing, while influencers were calling bottoms and tops, while retail was glued to price action, Google quietly released a quantum computing research paper that didn't just challenge how we think about encryption, it issued a countdown, a hard deadline, and right now, most of the crypto world is sitting completely exposed to what's coming, while acting like nothing has changed. But here's the part no one is saying out loud. There is one network that didn't panic when that paper dropped, because it had already been preparing. And when you understand what that preparation looks like, and what it means for the next phase of this market, you will never look at your crypto portfolio the same way again. Welcome back to Ledger.Wealth.Network, where we don't chase price, we chase structure. Today, we are pulling back the curtain on what Google's quantum research actually means for your assets, why most blockchain networks are quietly sitting on a ticking clock, and why the XRP Ledger's response to this threat could represent one of the most important infrastructure advantages in the entire digital asset space. This is not speculation, this is engineering. Let's get into it. Let me start with the hard truth that almost no one in this space is willing to say clearly. The security of your crypto, every Bitcoin, every Ethereum, every token in every wallet you own, is protected by a type of mathematics called elliptic curve cryptography. You've probably never thought about it. You don't need to think about it until it stops working. And here is the brutal part. This system was never designed to be unbreakable. It was designed to be so difficult to break that it would take a classical computer millions of years to crack it. The assumption was simple. No computer would ever be fast enough to make the attempt worthwhile. That assumption held for decades. Google's March 30th findings suggest that assumption is now on borrowed time. Quantum computers don't operate like the machine sitting in your home or office. They don't solve problems by running through possibilities one at a time. They exploit something called quantum superposition, the ability to exist in multiple states simultaneously to analyze the underlying mathematical relationships that protect your private keys. And the algorithm they use to do this, called Shor's algorithm, is specifically engineered to dismantle elliptic curve cryptography. What would take a classical computer thousands of years could, according to the research, be accomplished by a sufficiently powerful quantum machine in under an hour, potentially in minutes. Now here's where it gets personal. Every time you send a transaction on the blockchain, there is a window, a brief open window, where your public key is visible on the network before the transaction is confirmed. Traditionally, that window meant nothing. No computer was fast enough to exploit it, but in a post-quantum world, that window becomes a vulnerability. A quantum attacker could see your public key, reverse engineer your private key, and drain your wallet, all before your transaction finishes processing. The very act of using crypto becomes the attack surface. This is not a future problem. Google's research pushes the threat timeline to as early as 2029. That's not a generation away. That's 3 years from now. And the networks that are still debating whether to upgrade their cryptography in 2029 are going to be too late. Here's what most retail investors don't understand. Upgrading a blockchain's core cryptographic system is not like pushing a software update. These networks are decentralized. Any fundamental change requires consensus from thousands of participants. That process is slow, and in technology, the slow system doesn't survive the fast threat. Let's talk about the numbers, because this is where the picture becomes undeniable. There are roughly 100 billion XRP in existence. That number is fixed, it cannot be inflated. Right now, approximately 55 to 57 billion are in active circulation, with the remainder locked in escrow and released on a predictable schedule, most of which gets relocked every single month. Now set that aside for a moment and think about what the XRP ledger is actually built to do. Global cross-border payments represent $150 trillion annually. The foreign exchange market turns over $7.5 trillion every single day. The Nostro and Vostro accounts, the pre-funded liquidity buffers that international banks are required to maintain, have $27 trillion sitting frozen in accounts around the world at any given moment. That capital earns nothing. It exists purely to satisfy correspondent banking requirements. XRP's on-demand liquidity system is designed to eliminate the need for those buffers. Think about what that means mathematically. You want to move $500 million across borders in real time. At current XRP prices, you need a significant number of tokens to bridge that transaction. But here's the key insight. As the price of XRP rises, fewer tokens are needed to facilitate the same dollar-denominated transaction. The system becomes more efficient, not less, as the price appreciates. This isn't a Moonboy fantasy. It is a design requirement built into the architecture of the system itself. Now layer in the quantum threat. If even a fraction of the $27 trillion in Nostro Vostro capital begins migrating into quantum-resistant digital infrastructure, institutions will not move that money onto networks that are still running legacy cryptography. They will require, not prefer, require infrastructure that can survive the quantum era. And if only 1% of that migration flows through systems that meet the security threshold, we are talking about $270 billion in institutional demand seeking a very limited number of quantum-hardened tokens. Think about that math. Fixed supply, shrinking liquid float, $27 trillion in legacy capital looking for a secure landing zone. The math doesn't lie. It never does. Now let me show you what the smart money is actually doing, because this is where the signal separates from the noise. While retail investors were watching price charts, Ripple, the company most closely associated with the XRP Ledger's development, completed the acquisition of Hidden Road, a prime brokerage that clears over $3 trillion in transactions annually and services more than 300 institutional clients. $3 trillion. 300 institutions. That is not a company making a speculative bet. That is a company building the plumbing for a financial system that does not yet exist at scale, but will. At the same time, the XRP Ledger's development team has been quietly running something called an alpha network. This is not a press release. This is not a roadmap item that lives in a PDF somewhere. This is a live, active testing environment where engineers are stress testing quantum-resistant cryptographic systems, specifically lattice-based cryptography, under real-world conditions. The algorithms being evaluated, including MLDSA and a variant called dilithium, are not experimental concepts. They are systems already under review by the National Institute of Standards and Technology as the post-quantum security standard for the United States government. Let me be clear about what that means. The US government is moving towards the same cryptographic standard that the XRP Ledger is testing right now. When institutions, regulators, and sovereign entities align on a security framework, and a network is already live testing that exact framework, that is not coincidence. That is positioning. Ask yourself this. Does a firm like BlackRock or Fidelity or Franklin Templeton, entities that have already made public moves into the digital asset space, build custody infrastructure on networks they believe will be cryptographically obsolete in 3 years? They don't speculate. They don't gamble. They conduct due diligence that most retail investors never see, and they position years before the opportunity becomes obvious to the public. The signal is clear, but only for those who are actually looking. The timeline here is not vague. It is precise. Google's research points to 2029 as the year when current encryption standards face meaningful quantum vulnerability. That means institutions are not evaluating which networks to trust in 2029. They are making those decisions now, because infrastructure migration at scale takes years. The financial system does not move on short notice. It moves on long-range planning cycles, and those cycles have already started. In 2025, the Digital Asset Clarity Act began its path through Congress, a regulatory framework designed to finally distinguish between digital commodities and digital securities. When that framework reaches full implementation, the risk premium currently suppressing institutional capital flows into crypto begins to collapse. Wait-and-see money becomes positioned money almost overnight. And that moment, when regulatory clarity meets quantum urgency meets institutional infrastructure, is when the window for retail participation at current access levels begins to close. Not slowly, rapidly. The catalysts are not hypothetical. They are dated, they are documented, and they are converging. We are entering a transition that only happens once in a financial technology cycle, and most people are going to miss the entry point because they are still waiting to feel safe. Think about what happens to XRP's liquid supply as institutional custody accelerates. Exchange reserve data has been tracking a consistent pattern: tokens leaving centralized exchanges and moving into long-term custody positions. When a token enters a multi-signature institutional vault, managed by a qualified custodian under a regulatory framework, it does not come back to market for a 5% swing or a 10% profit. It is gone from accessible supply for years. Right now, you can still acquire XRP by the whole token. At some point in this transition, that changes. The math of supply and institutional demand is not kind to the patient skeptic. Once the quantum threat becomes a mainstream headline rather than a research paper footnote, the networks that are already compliant and quantum hardened will reprice faster than most people can react. The institutions have spent years building infrastructure while retail debated whether XRP was dead. That infrastructure is now almost complete. The question is not whether the door will close. The question is where you're standing when it does. I understand the frustration. I understand what it feels like to watch a thesis take longer than expected to play out. I understand the psychological weight of holding a position through noise, through FUD cycles, through headlines designed to shake confidence. But as an analyst, my job is to separate the noise from the signal. And right now, the signal on the XRP ledger has never been stronger or more structurally supported. Red candles are not evidence that the thesis is broken. They are evidence that the accumulation phase is still underway. The quietest predators are always the most dangerous, not because they are hesitating, but because they are focused. While the crowd is performing emotional reactions on social media, the architects of the next financial layer are signing contracts, building nodes, and testing cryptographic systems that will determine which networks survive the quantum transition. Being early feels exactly like being wrong, right up until the moment it doesn't. The investors who will look back at this period and wonder why they didn't hold with more conviction are the same ones currently second-guessing themselves because the price hasn't moved yet. The structure is in place. The catalysts are dated. The institutional positioning is documented. The only variable left is time. Here is the bottom line. Crypto has survived every crash, every ban, every skeptic, and every obituary the financial press has written for it. But the quantum era is not going to be survived by every network. It is going to be survived by the ones that were building the right infrastructure when it wasn't fashionable, when it wasn't priced in, when most of the market was too distracted by short-term noise to pay attention. The XRP ledger is not perfect. No network is. But on the axis that will matter most in the next 3 years, quantum security, institutional readiness, regulatory compliance, and architectural adaptability, it is further ahead than the consensus currently reflects. Price is a distraction. Structure is the reality. Drop a comment below with the word vault if you made it to the end, and you actually understand what we just broke down today, because the informed don't need hype. They just need the right information at the right time. I am Ledger.Wealth.Network. The math doesn't lie, and the system is almost complete.